The report that the OBR have published this morning shows that even in the most benign version of a no-deal exit, there would be a very significant hit to the UK economy, a very significant reduction in tax revenues and a big increase in our national debt, a recession.
Hey there, and welcome to another Brexit Explained video. In this one, we're going to talk about the economics of the UK leaving the EU without a deal. We've been considering making this video for a while now, but over the last few days, there's been some pretty major announcements which have sparked us into action. First, the Office of Budget Responsibility published a report into the anticipated effects of a no-deal Brexit, and, well, the results weren't pretty. Then Philip Hammond made some pretty damning remarks about the impact of a no-deal. Finally, in an interview with Andrew Marr, Hammond announced that he plans to resign from his role as Chancellor if Boris Johnson becomes the new Prime Minister.
Indeed.
Do you think you're going to be sacked?
No, I'm sure I'm not going to be sacked because I'm going to resign before we get to that. Assuming that Boris Johnson becomes the next Prime Minister, I understand that his conditions for serving in his government would include accepting a no-deal exit on the 31st of October. That is not something I could ever sign up to. It's very important that a Prime Minister is able to have a Chancellor who is closely aligned with him in terms of policy, and I therefore intend to resign.
I can never remember a Chancellor of the Exchequer, or indeed another senior minister, announcing his resignation live on national television. A moment, I suppose. But can I ask...
It's a first, Andrew.
So, in this video, we're going to talk about the OBR's report and discuss what would happen in the economic aftermath of a no-deal Brexit. We'll also discuss whether that report can actually be trusted. Before that though, just a quick thank you to all of our patrons. All of our backers make it possible for us to create videos and react quickly to events like this. If you want to support the channel's growth and help us create more videos, then back us on Patreon. In return, you get all kinds of perks, like early access to some videos, discounts on our merch store, exclusive behind-the-scenes podcasts, and much more. Find out more about what you'll get from backing us by clicking the link in the description.
The report that the OBR have published this morning shows that even in the most benign version of a no-deal exit, there would be a very significant hit to the UK economy, a very significant reduction in tax revenues and a big increase in our national debt, a recession caused by a no-deal Brexit. But that most benign version is not the version that is being talked about by prominent Brexiteers. They are talking about a much harder version which would cause much more disruption to our economy, and the OBR is clear that in that less benign version of no deal, the hit would be much greater. So I greatly fear the impact on our economy and our public finances.
So before we dive into the report, some context. The OBR, or Office of Budget Responsibility, is a non-departmental public body who are funded by the UK Treasury. The government created the OBR so that they could provide independent economic forecasts and independent analysis of the public finances. Analyses like the July 19th Fiscal Risks Report. And that's exactly the report we're going to be discussing today, the one Hammond spoke about earlier. The report discusses a variety of fiscal risks, but it's the risks that relate specifically to Brexit that have garnered the most attention in recent days. So, let's start with the headlines. As Hammond alluded to earlier, the OBR's report states that even in a relatively benign no-deal Brexit, the UK's public finances would drop by £30 billion a year. When conducting their analysis, the OBR based their figures on a mild version of no-deal Brexit. Chair of the OBR, Robert Choate, went on to say that the figures assume that there'd be no disruption at British ports, as well as a relatively short recession, with few permanent scars to the economy. As Hammond mentioned earlier, this is a relatively conservative estimate, as the kind of exit Johnson is proposing would undoubtedly create bigger issues at ports and create more long-term damage. But let's leave that to the side for a second and look at some of their specific findings. As Choate said, their analysis assumes only a short recession, but they're predicting a recession nonetheless. This graph outlines how GDP will be impacted by a no-deal Brexit. The first section shows the current rate of GDP growth, and this section shows how GDP was predicted to rise in the OBR's March 2019 forecast. However, when that's adjusted to include the mild no-deal scenario, you'll see this curve here. GDP isn't the only area they predict would take a hit. The OBR report also shows that debt is expected to rise by 12% of GDP when compared with the original March 2019 forecast. In March, they predicted that the national debt would continue to fall over coming years, but even their mild no-deal model shows that national debt is expected to rise in the years following a no-deal, something which would significantly damage the UK economy. At the risk of throwing too many graphs at you, let's look at one which shows the rate of public sector borrowing in this no-deal Brexit scenario. The OBR predicts a significant increase in borrowing in the years following a no-deal Brexit, with the 2021-22 rate of borrowing nearly 35% higher than it was in 2018-19. The difference is even more stark when you compare the difference in their predictions of what would happen to borrowing if the UK and EU reach a deal versus if they don't reach a deal. So that's enough graphs for the moment. Let's look at a few of the other things that the OBR report predicts. They anticipate that prices will rise faster than wages, meaning a pay cut in real terms. They also expect house prices to be 8% lower than their initial March estimate. They predict that the pound's value will fall by 10% versus the euro, and they anticipate that business investment will drop by 10%, which is particularly damaging as business investment is normally seen as a major driver of productivity and growth. So those are some particularly worrying stats. No country wants to see its productivity fall and its rates of debt and borrowing rise. But remember, this is a more conservative estimate. In the past few months, both the Bank of England and the Treasury have conducted a similar analysis and found even more worrying results. That's because the forecasting methods they used were more severe than the OBRs and included more significant consequences for leaving without a deal. Therefore, the chair of the OBR does note that in a more disruptive no deal, the effects would be bigger, potentially closer to the £90 billion a year impact that Hammond has regularly referenced. That's not to say that the milder form of no-deal Brexit, which is used in this report, is great either. Sure, it might only be £30 billion a year rather than 90, but if these models prove to be correct, then that's still a huge impact to the UK economy. In fact, Hammond has even commented that this milder form of no-deal would cause a very significant hit to the UK economy, a very significant reduction in tax revenues, and a big increase in our national debt. The difference between the Bank of England, the Treasury, and the OBR reports does highlight an issue with this kind of analysis. All of them are using best guesses for how the economy will react to the changes that no deal poses. The problem is that there's millions of different variables in an economy, so guessing how it will react is hard. With something as politically divisive as Brexit, it becomes incredibly difficult to accurately predict how markets, governments, and customers will react, and therefore it's incredibly difficult to model out what's likely to happen. All of these institutions are experts in constructing this kind of modelling, but when it comes to issues as unprecedented as Brexit, it's really hard to tell how significant the impact will be. Doubters might say that the impact won't be as significant as the OBR claims, and that the UK could use the £39 billion divorce payment that they might not end up paying the EU to balance the negative economic effects. In fact, the OBR's chair responded to this, saying that there's a world of differences between a hit to the economy and public finances, which is an ongoing one over time, versus a relatively large but one-off sum. Okay, so what about the savings made by no longer having to pay EU membership fees? If the UK doesn't need to keep paying towards the EU's budget, surely that will save a ton of money. Well, while the costs of EU membership certainly aren't cheap, the OBR's report shows that the drop in tax revenue would significantly outweigh the benefit of no longer having to pay EU membership fees. But can we really trust reports like these? Didn't they say there'd be a huge recession immediately after the referendum? A recession which never materialised. While that might be a valid criticism of some other institutions, the OBR has actually been pretty accurate with its Brexit predictions. In fact, the reality of the UK's economy today pretty much exactly matches the OBR's expectations for a post-referendum Britain. That hasn't stopped Boris Johnson from rubbishing the report's findings, describing them as rubbish in, rubbish out. Now this might sound like a rather glib response to the report, but it does actually highlight one of the major differences between people's predictions. It goes some way to explain why Jacob Rees-Mogg predicted that the UK will be £80 billion better off a year post-hard Brexit, and Hammond says that the UK will be £90 billion worse off. Both men are working under different assumptions. By changing the assumptions you feed into an economic model, you can make it give you whatever results you want. Brexiteers will claim that the OBR's modelling is too pessimistic and doesn't take into account the benefits of new trade deals, which to them is the reason for the negative results. But that being said, there's a whole load of economic reports that predict that the UK will be worse off after Brexit. And there's only one notable report which says the UK will be better off after Brexit. And that's exactly the one that Mogg uses as the basis of his claims. The OBR has tried to avoid these partisan fights by attempting to balance out the extreme optimists and the extreme pessimists. They try to give a realistic, more moderate approach by using a mild no-deal scenario. But even this balanced approach doesn't paint a good picture for the UK's future. The only way we'll know whether the OBR's pessimism is justified is by waiting. If the UK ends up leaving without a deal, we'll see quite how significant the impacts of no deal really are. We will of course keep you updated with this and everything else Brexit as time goes on. To make sure you don't miss a thing, subscribe to us on YouTube. Also hit the bell icon to make sure you're notified every time we release a video. While you're at it, you can also follow us across other social networks simply by searching for TLDR News. Also, as I mentioned at the beginning, our backers on Patreon make this possible, so if you want your name featured at the end of the videos like these people, make sure to sign up. There's a link in the description.